Today's interview is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about VanEck's income-focused ETFs later on, but for now, let's get into today's interview. Super excited to welcome back to Forward Guidance Brent Johnson of Santiago Capital. Brent, welcome back to Forward Guidance. How have you been?
Good. I'm happy to be here. Thank you for the invite.
I'm really happy you're here, Brent. You focus on all things the dollar, and a lot of people are talking about the dollar because other countries are trying to sort of move off the dollar standard. And Brent, I just want to ask you, one thing that it's kind of just bothering me is that the dollar's dead. Everyone knows the dollar's dead. It bothers me when people still want to conduct business in dollars because I've got my yuan. I've got my Brazilian real, and let's do this. I mean, why are people still wanting to be conducted in dollars? Why can't people accept that the dollar isn't only dying, it's already dead?
Well, that's a good question. Based on all the headlines, the dollar's days are over. You might as well just burn all your dollars because they're worthless. And, we're going to go to some new BRICS-based currency or some new hard asset-backed currency. And it sounds like it's a done deal. So I'm not sure what the holdup is.
Yes. Of course, I am joking, Brent. So You're known as someone who people think of you as a dollar bull, and someone who is a defender of thinks the dollar system is here to last. And those are two different things. For the first part of this conversation, at least, Brent, I want to just talk about the sustainability of the dollar system, which is different than the level of the dollar. The dollar could be strong against other currencies, but people stop using the dollar. And likewise, the dollar could fall in value, but people still use it a lot. For our first half, we're not really talking about will the dollar be strong or weak. It's just, will the global dollar system continue? So with that, I want to sort of propose to you the reason why people are noting that the dollar global standard, the days might be limited. So Brazil and China are in the BRICS alliance, Brazil, Russia, India, China, South Africa, and they announced an agreement to conduct all future trade transactions using their own currencies, not dollars. India is starting to use non-dollar currencies to transact with the UAE, the Russia. So trading partners are moving away from using dollars, and the thinking goes, this will continue. The dollar standard will disintegrate. What is your view on this?
I think there is anti-dollar hype right now. I think there is a lot of emotion and a lot of excitement about the possibility for it. So I'm not going to downplay the number of headlines, the excitement with which they're made, and the desire. There is great desire for this to happen. I think the likelihood of it paying off or playing out is, at least to the extent that many are people just accepting as a given, is extremely unlikely. And part of the reason is because I think we're at a place in history where the whole world is in the process of kind of, turning over, for lack of a better word, this fourth turning, right? This great reset. And all of these programs that these headlines are talking about, at this point, they are plans, right? And if you read the articles carefully, they will often say something like, we have entered into an agreement to start discussions about a potential plan that could one day be implemented. So none of these headlines say it's going to happen right now. From a very high level, my view on this is these announcements are not surprising. Maybe the rapidity with it and the volume with which they're being said, and the frequency with they're being said in the last, let's call it, month, is new. It's the statements themselves are not new. I think it's important to remember that the BRICS organization, which is basically a loose trade federation, kind of at best, was founded in June of 2009, kind of at the bottom of the crisis, the global financial crisis. And from the very beginning, it was a way to increase trade amongst these, the global South, or however you want to describe this, right? Some of the emerging markets. One of the ideas was that they will come up with some kind of a common currency which they can conduct trade. And for the last 14 years since that was first announced, every year they get together and they talk about these things, and they come out and they make a statement and said, we're working towards doing this. But so far, nothing has actually been done. Now, that's not to say that it never will be done. it's just to say that these announcements aren't surprising because they've been announcing them every year for 14 years now. There hasn't been a lot of actual progress. Now, again, that doesn't mean that there won't be. It just means that there hasn't been. And so when I see these headlines, it's not that I don't pay attention to them. You have to pay attention to them. When that big of a portion of the world's economy makes announcements, to just ignore it would be stupid. So I don't ignore it, but I also just don't take everything as complete fact, because these announcements have been around for a long time. I'll give you a very good example of why I'm a little skeptical of these. Number one, it's very easy to say. Number two, it's very hard to do. Number three, if it was easy to do, they would have already done it, because again, this was announced. The intentions of this was announced 14 years ago. 4 years ago, in 2019, there was a big headline that came out that between China and Iraq, and it said that China and Iraq were no longer going to conduct their oil trade between the two in dollars. And this was heralded as a nail in the dollar coffin. The petrodollars days were numbered. And the idea was that Iraq was going to sell oil to China, and in exchange, China was going to provide consulting services, build infrastructure, construction. They would pay in-kind services for this oil rather than pay dollars. And this was a big announcement. And then what it actually was, when you looked into the details of it, the amount of and so many people said China will no longer buy any oil from Iraq in dollars. Well, that's not true, because this deal only accounted for about 10% of the oil trade between Iraq and China. And then it turns out that the deal was never actually implemented. None of this has ever happened. And so, there's a big difference between a headline and a reality. One of the analogies I've used is, for 15 years, I've had a plan to join the PGA Tour. Hasn't happened yet. I would love it to happen, and I'm really serious about it. But, the likelihood of me playing against Tiger Woods in the Sunday at the Masters is pretty low. But again, I say that jokingly only because this problem that's being dealt with by the rest of the world, this de-dollarization problem, is an extremely complicated one. And it's extremely complicated for a number of reasons. And I understand all the reasons they would love to get out from underneath this system, but it's just much, much easier to say than do. And if all it took was anger and frustration to de-dollarize, the world would have been de-dollarized decades ago. But it isn't, because it's this Gordian knot that it's really hard to untie it. And another analogy that I would use is it kind of reminds me of the Green New Deal headlines that we've seen for the last 5 years. For the last 4, 5, 6 years, you've seen a number of headlines. We are going to shut down traditional energy. There's going to be no more coal plants. The pipelines are going to be shut down for environmental reasons because of global warming. And we are going to transition to green energy. Okay, that's fine. And that process takes a while. Maybe it takes 5, 10, 20 years to do that. The problem is before those new programs were up and running, we had an energy crisis. We had a crisis that led to traditional energy spiking last year. Now, I think that's kind of the same thing that's going on with these efforts to de-dollarize. I have no doubt that the efforts are being made, and I have no doubt that plans are being put in place. I think that we are going to hit the wall with the global economy before those plans are in place and implemented. And when that happens, I think traditional finance or traditional global funding will spike in price in the same way that energy was spiking in price a year ago. And traditional funding is done in dollars. So that's one thing I would say. So I'm not diminishing the effort. I'm not diminishing the desire. What I'm diminishing is the capability and the timing of getting it in place in time. And part of the reason is that the process of de-dollarization goes in hand with the process of de-globalization. But the problem here is that every time we have had some kind of a global slowdown, economic slowdown, or a global crisis over the last 25 years, you always see the US dollar spike in that scenario. So now, if we're going through some kind of a great reset, or we're going into some kind of a conflict, or we're going into some kind of a de-globalization, that is probably not going to be a smooth transition, even if everybody was getting along and trying to do it in a cooperating manner. I think even under the best circumstances, it would be volatile. But this will not be done under the best of circumstances. The world is no longer cooperating to the same extent it was. And the US, for better or worse, whether you think they should or shouldn't, will not just stand by and watch as its place in the world is degraded. And so I think they will push back, and that will lead to volatility. And so I think what's going to happen is we're going to get into a crisis, and I think the dollar is going to spike just like it always does. I don't think it's different this time. And I'm not saying that everybody should go out and bet on the US dollar going higher. That's not the point of me pounding the table on the dollar. The whole point of me pounding the table on the dollar over the last 3 or 4 years is not to convince everybody that I'm right. It's to convince everybody not to bet everything that I'm wrong. Because if you bet everything that I'm wrong and things play out the way they always have, you're going to get crushed. And so, the reality is that's a big part of what I see a lot of bad takes on how this is going to play out. And it's not that they can't play out that way. It's just that the probability of them playing out that way is extremely low. But I've talked to too many investors over the years who they hear something like this. They say, oh my gosh, I have to get out of dollars. And they run and they put 70% of their portfolio in gold or uranium or some kind of hard asset or some kind of an anti-dollar play or an anti-United States play. And rather than just, playing the probabilities, they go all in on it. And I really want to kind of help people understand why you shouldn't go all in against the United States and against the US dollar. Not because I'm an American exceptionalist, not because I'm a jingoist American who thinks we're the greatest power in the history of the world and nothing could ever bad happen to us. I think the US is going to experience tremendous pain in the years ahead. I don't think it's going to be easy, and our role in the world may very well be diminished. But this is not going to happen in a calm manner. And I think when the volatility shows up, I think you will see the dollar go higher.
After last year's interest rate surge, income has made a comeback, and VanEck has the ETFs to help bring income to your portfolio. You can check out VanEck's wide range of income-focused ETFs using their income investing yield monitor, where you can search by yield, duration, and expense to find the ETF that fits your needs. With the yield monitor, you can effortlessly track monthly fixed income ETF category flows, yields, total returns, and more. To access VanEck's income investing yield monitor, go to vaneck.com/forward-guidance. Now the disclosures. Investing risk includes principal loss. Visit vaneck.com to read a prospectus before investing. VanEck ETFs are distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks, and let's get back to the interview. When I think of a global reserve currency, there's kind of a three-legged stool. If there's a fourth or fifth leg, please feel free to add. But it's trade invoicing, currency reserves, and then dollar-denominated debt. So when people buy and sell oil, copper, soybeans, if Brazil sells it with China, historically it was done in dollars, despite the fact that neither of those countries control the dollar. Likewise, with China has a huge trade surplus, and the U.S. has a huge trade deficit. So China can park those assets in U.S. Treasury, so currency reserves. It's the global reserve currency. That's where that term comes from. And then dollar-denominated debt. If a country wants to issue debt, sometimes, in Argentine pesos, it can be hard to borrow money in that currency. You have to pay 40%, 100%, right, something like that. So they borrow in dollars. And then you get the emerging market debt crises, which you know all too well about that. So those are kind of the three spokes of the wheel. Let's start with trade invoicing. What was the historical advantages of Saudi Arabia selling oil in dollars? How did that sort of system work? And then why are the arguments that Saudi Arabia is going to move away from that flawed?
Yeah, so this is a very good example for us to use, because whenever you're talking about a productive economy, you have to kind of go back to kind of the first principles. What allows an economy to be, prosperous and profitable and efficient? Well, the first thing you have to do is be able to secure your own safety and your own subsistence. If you have to go out and farm every day, or you have to go hunt for your food every day just to stay alive, and you have to be a soldier or have people, being the protectors in order to make sure that you stay alive, that takes up a lot of time and effort, and it doesn't allow you to then go create a vibrant economy. Now, the reason this is important now is because the deal that was made between the United States and Saudi Arabia, the Kingdom of Saudi Arabia, back in the early 70s, was that the House of Saud, which was the ruling family in Saudi Arabia, made a deal with the United States. And the deal was, we will price our oil in dollars. And as a result, the US will provide protection to that family, keep them in power over the years. When other factions within Saudi Arabia try to challenge their status as the king or the head of the country, the US would, help them defend against that, and they would help them defend against foreign adversaries, and they would help them build an incredibly modernized global country. So if you go to Saudi Arabia now, the highways are fantastic, the hotels are 5-star, there's swimming pools, there's all, malls, movie theaters, power grid, it's a very modernized society, which it wasn't 50 years ago. But that was the deal. You provide the world with oil and dollars, and we will help you do all these other things. So now, if for this to change, if Saudi Arabia were to go back on their side of the deal, well, then the United States is not going to keep their side of the deal, right? And Saudi Arabia does not necessarily have the ability to defend itself. And I'm not saying they're totally incapable, but my point is they would no longer have the U.S. as a protectorate in that scenario. And I know some people say, well, that's fine, and they will just partner with Russia or China, and Russia and China will come in, and they okay. Let's pretend for a second that that's the case. Let's pretend that decision is made, that they're breaking the 50-year-old deal between the U.S. and Saudi Arabia. Saudi Arabia is now going to partner with Russia and China. How do you think the United States is going to react to that? My guess is that they would not be happy. My guess is that they would not just fly back to Washington, D.C. and say, okay, darn it, I guess we lost that one, right? They're going to push back against this. And even if this actually does change, how long does it take for China or Russia to get in there and set up their bases and set up their systems and set up their defense capabilities inside Saudi Arabia to defend Saudi Arabia? My guess is that's probably a years-long process. But even if it could, let's pretend for a second it could be happened in 2 weeks. Well, what do you think happens in that 2 weeks? Do you think the U.S. just goes home and watches from afar over that 2 weeks, or do you think they try to subvert that effort a little bit? I would be willing to bet they would try to subvert that effort a little bit. And in that chaos that would come out of that, I think there would be economic turmoil. So again, this ability to just switch things like a light switch from one system to another and one treaty to another, I'm not saying it can't happen, but in my opinion, it will not happen in a peaceful manner.
On March 29th, Saudi Arabia announced it had agreed to become a dialogue partner. It's funny, you're making all this point about words over actions. They say we're becoming a dialogue partner in the Shanghai Cooperation Organization, a China-led political organization designed to compete with Western organizations. And then you had Total Energies, a gas company, announced that it had completed its first purchase of liquefied natural gas, LNG, from a Chinese oil company using the Chinese yuan as the currency. So, Brent, I definitely acknowledge there's a lot of hot air, empty verbiage, just journalists getting a lot of articles that they can write about that people get very worked up over it. And not being backed up by facts of the ground of folks de-dollarizing, and when they trade, they're using a different currency other than dollars. But there is some of it. The argument that you just in your most recent response just elaborated on, that sounds like a political argument. Okay, the U.S. is going to retaliate in some way if they stop using the dollar. Is there also an argument that the U.S. dollar is entrenched in a way and has advantage to be the global reserve currency in a way that the Chinese yuan isn't? I'll give you an example. The massive debt that the U.S. has can actually be an asset of other people, whereas China does not. People don't own a lot of Chinese bonds because China is a creditor, not a debtor. And so, are people going to own Chinese bonds, or there aren't enough of them?
Yeah, there's kind of three pillars to the U.S. dollar being the global reserve currency. So after World War II, the U.S. came out on top of World War II. Maybe not the sole winner, but largely the best positioned participant in the war after World War II. And so they, along with Europe, set up the Bretton Woods system and the current global order. And when they did, they stacked that deck in their favor in order to keep it that way, right? And so, and in that scenario, they set up the U.S. dollar would be the global reserve currency, but it would also be backed by gold. So in many ways, gold was kind of the global reserve. It's just that the dollar was tied to it, right?
Now, and Brent, sorry, in the first Bretton Woods, if a country developed a trade imbalance, there would be a mechanism that would self-correct that, be the International Monetary Fund, IMF. And by the IMF, it's called international, but it's pretty much run by the US, right?
Right. Yeah, and not only that, but the currency was convertible. So if you felt like the trade was getting out of whack, or that the U.S. was running too big of a budget deficit, or they were no longer being as fiscally responsible as they agreed to be, you could exchange the dollars for gold and take the gold home. Right, and that's exactly what happened in the late '60s. France didn't like, with the cost of the Vietnam War and the implementation of a number of social policies that cost a lot of money. France said, "Give me the gold," and they even sent, they famously sent a warship to New York Harbor to collect the gold and take it home. And as a result, Nixon delinked the dollar from gold. He no longer made it convertible, and that ushered in the area of floating exchange rates. Now, it's important to understand this. Had Nixon done that just out of the blue, and had the EuroDollar market not existed and been developed for 20 or 30 years at this point, that would have bbeen a much harder problem to deal with. It was a problem anyway, but it would have been much harder to deal with. Now, let me tell you what I mean by that, because this is so one of the pillars was that they won the World War II and they set up the US as the center of the global world order. That's one of the pillars of the US dollar. The other pillar is the EuroDollar market. Now, interestingly, this is not a government sanctioned or enforced system. This was the private market outside the purview of regulatory bodies and government agencies doing business with each other in dollars all over the world outside the United States. So because they were, as part of the Marshall Plan, they were rebuilding all of Europe. There, and because U.S. was providing a lot of the financing, there was demand for dollars in Europe. There was also demand for dollars by Russia and the now Soviet bloc to use dollars because they needed to do business outside of Russia, and nobody wanted to use rubles. So Russia started holding U.S. dollar balances in European banks back in the 50s, 60s. And so these were called EuroDollars, not euros. This isn't the euro currency, it's EuroDollars. And then, countries, because there was so much demand for dollars, because that was kind of the common currency, people started transacting in dollars. And, Japan would do business with the Philippines in dollars, and Brazil would do business with the United States in dollars, but they would do business with Argentina in dollars. And so South Africa would do business with India in dollars. And these are the types of things that happen. And this was private individuals, private companies, private actors, not government-sponsored actors, entering into global commerce using dollars. And so from the 50s, 60s, and the 70s, this whole network of dollar credit, dollar invoices, and dollar balances sprang up outside the United States. And that market for dollars outside the United States, the EuroDollar market, is bigger than the market for dollars inside the United States. So it's enormous. And so there was all this demand for dollars outside the United States when Nixon delinked the dollar from gold. And so you did see a lot of inflation in the 70s. But part of the reason it didn't become hyperinflationary, and part of the reason it didn't lead to a collapse of the US dollar, is because there was so much demand for the dollar outside the United States. And so the EuroDollar market is another piece of the backing of the United States dollar. The third one is all the US dollar debt, which is sort of related to the EuroDollar market. It's a part of it, but it's a big part of it, and it's very important to understand. As you mentioned earlier, if a company outside the United States decides to raise money via a bond issuance or taking out a loan, if they do it in their local currency, let's say it's Turkish lira or Egyptian pound or Indian rupee, they're probably going to pay a lot higher rate of interest because there's not as much demand for that currency outside their country. But if they borrow in dollars, the rate is typically lower, And so they get cheaper financing. And because they're probably doing business in dollars, they've kind of matched their revenues to a certain extent with their debt. That's one of the reasons they would do it. The problem is, so now there's all of this US dollar debt outside the United States, and it's enormous. Again, everybody knows that the US owes 30 trillion. Well, the rest of the world owes more than that to each other. And here's the real key part of it is they don't owe these dollars to the United States. They owe these dollars to each other. Again, this is a French bank making a loan to a Turkish company, or a Japanese, company doing trade finance in dollars to a Philippine, supplier. And there's a number of examples like this, but it's all done in dollars. And so if the rest of the world just defaults on this euro dollar debt, they're not defaulting on the United States. They're defaulting on each other. So while their liabilities would disappear if all this defaults happened, a lot of their assets would disappear as well. And so this is what makes it so hard to de-dollarize. To destroy the dollar system, the rest of the world has to destroy a huge portion of their own reserves. And it's just very hard to do that. And so that's another thing that backs the currency. The other thing is that, you mentioned the capital markets. If you're going to do business with the United States, it's going to be done in dollars. So the US is typically every country in the world's either first or second biggest customer. Europe, I think, is or either Europe or China might be one or two, but then the US is always number one or two as well. And so if these foreign companies are going to totally de-dollarize and no longer use the dollar, well, then they're not going to do business with the United States. The United States is not going to conduct business in yuan or reals or euros. The US is, so if you want access to US markets, you're going to need to use dollars. And because we have the biggest consumer market in the world, everybody wants to sell here, right? So if the idea that China and Brazil are going to do all this business together and they're going to shut the US out, well, then they're not going to sell to the United States anymore, right? And so that's a lever that the United States, so that helps back the US dollar. And then finally, the one that nobody likes me talking about is the military. A lot of this stuff gets self-reinforced on its own. We don't need the US military. But my point is if it ever came to it, if the US was ever in serious threat of losing its place in the world due to economic functions, I have no doubts that they would use their military to help out, right? And I don't like that. I'm not advocating it. I'm not saying that should be the way it is. I'm just saying that's the way it is. And you need to understand that. And so that's another way that's another prong for the US dollar. And the reality is there's just no other country in the world that can do all those things right now. Now, I know the rest of the world is trying to put together a coalition in order to counter it. And perhaps one day they will be successful. But right now, today, it's extremely unlikely. And that's the point to get across is it's okay to understand that it could happen. And it's okay to put a portion of your portfolio on the possibility of it happening. But don't confuse a possibility with a high probability. That's kind of the message that I try to get across.
Yeah, and just on that point, de-dollarization, in the long term, it definitely could happen. I think next year probably going to be using the global need a lot of dollars, and the year after that probably as well. So folks, investors thinking about their own time horizon, like if they think they could have this de-dollarization view that over 50 years plays out, but in 2 years they lose a lot of money because they made certain investments that for an ultra extremely long view.
Right. No, exactly. I want to make a point really quick. And part of the reason that one of the arguments that's given for this de-dollarization effort now and why it could succeed now is because the US wasn't just messing around with Iraq or Afghanistan. Now they're messing around with China and Russia, who are nuclear powers. And we can't just bully them to do whatever we want them to do. And there is absolute truth to that. And I'm not denying that at all. But the flip side is also true. The US doesn't have to just go along with anything either, because you know what? They have a lot of power as well. So the idea that there's no way we could beat Russia because they have nuclear weapons. Well, then why is it so easy for Russia and China to beat the United States? Because we have nuclear weapons too. And so again, I hope to God this doesn't become some kind of a kinetic shooting war. But the idea that the US cannot possibly win And that's the way a lot of these arguments come across, is that this is a given. De-dollarization is a given. It's just a matter of time. You might as well get on board because there is nothing the US can do to stop it. Well, unfortunately, if that's your view, there's a lot of things the US can do to stop it. Now, maybe they won't be successful. Maybe the rest of the world in this effort will win. But it will come at great cost, because the US will not just relinquish its role in the world. And I think it's really, really important to understand that.
You can make that argument about other countries too. For example, Russia basically had its foreign dollar reserves essentially canceled, something I think the US has also done to Iran. That can be quite bothersome. Your people from a country, if you're a leader, your people have worked so hard, have this extra surplus, you put it in dollars, and then poof, it's gone just because the U.S. agrees with you. That is a problem. So, I mean, do you see, for example, Russia anytime soon going back to putting money into foreign reserves? And the ruble collapsed in value during the war, but then Russia raised interest rates to 20%, and the ruble restored value.
Yeah, so with regard to the sanctions, and I doubt that Russia is going to go back to holding U.S. dollar balances. The reality is they already still do, and they, this idea that they only sell dollars, they only sell energy in rubles. Well, it's true, but the way that people get rubles is they send dollars or euros to Russia. Russia gives them rubles, and then they do the transaction in rubles. So this idea that Russia has totally de-dollarized is, again, it's headline versus reality. I'm not saying they're not making efforts, and I'm not saying that they haven't been somewhat successful in doing it. I'm just saying this idea that they no longer use dollars in any shape, way, or form it's incorrect. But I think in many ways the U.S. probably should not have done what they did. They probably should not have confiscated the reserves. I think when we look back on this 20 or 30 years from now, we will say that was a key moment in the whole de-dollarization or de-globalization effort. And so, that has definitely kind of led to what's going on now. Now, having said that, a lot of times people will say they shouldn't have done it, and they will say that sanctions don't work and sanctions have backfired and sanctions are having no effect. Well, okay, there's some truth to that, but again, it's not quite so simple. Like, sanctions do have an effect. I mean, if you disagree, then just go look at the GDP growth over the last 20 years of places like Russia, like Iran, like Venezuela, and some other countries around the world that have had sanctions put on them. It does have an effect. And the reality is that right now, those sanctions are having an effect on Russia. They had a pretty good year last year, but this year, their oil and gas revenues are down so much that they're running their biggest budget deficit in decades. And they've had to change the way they tax their energy companies in order to increase the Russian treasury receipts. So, the idea that it doesn't work at all, again, there's always nuance to all this stuff, and you can't just read the headline and accept the headline as fact. And so, I think this is an example of where, the U.S. probably, I try not to get too tied up in what they should or shouldn't have done, because they don't consult me on this stuff, and they don't consult anybody else on Twitter on this stuff either. They're just going to do what they do. And so my analysis kind of stays on what's actually going to happen, as opposed to what I think they should do. And the reality is they did it. They're probably not going to back down from it. Things will probably get worse before they get better. And, it's part of this, things will probably get worse before they get better. Part of my argument that we will have some kind of a crisis. Like, you can't have these types of things going on and have economic stability. It just, those two things just don't really go together.
And Brent, what is it about a currency, about a nation's currency, that other countries want to do business in and want to hold it, want to borrow in it? You said in the 50s and 60s and 70s, the Eurodollar system was born. Foreign companies and countries wanted to own the dollar, and that's why there wasn't huge inflation in the US in the 1970s when Nixon went off the gold standard. What was it about the dollar that was so attractive during that time? What was it that was so attractive about the pound sterling in 1890, 1900? And then, suddenly, the United Kingdom, Britain, emerged from World War II victorious, but with tons of economic damage, and suddenly the dollar take over. Like, what causes that domino to fall?
Well, there's a couple of things that make it the global reserve in the first place. Number one is typically the country that has the global reserve has one of the biggest markets in the world. Historically, that's kind of been the case. And you typically, countries around the world will want to do business with the global superpower, right? And if you're going to do business with the global superpower, again, whether it's Britain or the United States or France or whoever it is at the time, you're going to use their currency, right? And so the reason that people around the world would accept dollars is because it was in great demand around the world. One of the definitions for money is the most marketable commodity, which means it has the most liquidity. And it's just a fact that the US dollar had the most liquidity around the world compared to all of the fiat currencies. Now, I know there's several people out there saying right now, well, why don't they use gold? Gold is a much better store of value over time. Okay, this is absolutely true. And when they say that money is supposed to be a medium of exchange and a store of value, nowhere does it say that money is supposed to be the greatest store of value in the world. It just says it's a store of value. It doesn't say it's a good store of value. It doesn't say it's the best store of value. It just says it's a store of value. And I think most people who have studied money understand that fiat currency loses value over time. That, number one, is why governments use it. Governments, who are the ones that make the decisions, don't want money to be a good store of value. Governments don't want hard money. They want loose money that they can use to make promises with and then pay them off, right? Or use this printed money to pay off the promises. But going back to the global reserve currency, just because you have the global reserve currency doesn't mean it's going to be a great store of value. And that's why most people, or even institutions and central banks who earn dollar revenues, don't just put it in a vault in cash. You can buy gold with it, which many central banks have done. You can buy US treasuries, which many central banks have done. And those treasuries pay an interest rate. So again, the interest rate largely makes up for the loss of purchasing power. Again, if you're going to hold these for 100 years, fiat currency is absolutely going to lose value. If you hold it for 2 or 3 years and you have it in some kind of an asset that appreciates against the failing fiat currency, not so much. Again, you kind of have to understand the whole idea that the world is going to go back to a gold standard. Can it happen? Of course it can happen. Is it a possibility? Yes, it's a possibility. Is it a high probability event that's guaranteed to happen? No. And the reason is because the people in power, especially Xi and Putin, do not want handcuffs put on them. I mean, the idea that Xi and Putin are probably the two biggest, quote unquote, strongmen of the last 100 years, or at least since World War II. The idea that they would want to have their biggest tool dictated to them, as opposed to them being able to control that tool, to me is just laughable. Now, it might be forced on them. They might have to do it, but I don't think that they will do it willingly, nor would any other government leader. Now, this also doesn't mean that gold won't go to $5,000 anyway. I think gold will go much higher in the years ahead. I just don't necessarily think it's going to be because, Xi and Putin want a gold-backed currency.
I couldn't agree with you more, Brent. As folks watching this can see on your Twitter handle at Santiago AU Fund, as the AU might suggest, you are a gold bull as well. But Brent, I really agree with you on the gold standard. The Bretton Woods 3 thesis proposed by Zoltan Pozsar, that's not actually that we will go to a gold standard. It's just that gold will make up an increased percentage of foreign exchange reserves or reserves for government reserves as well as central bank holdings. And yes, you cannot conduct commerce in something of which there is such an unstable and limited value. Something like, you're going to go to the Starbucks and buy coffee with gold. It just doesn't work. And then you have paper that is backed by gold. We saw in the Great Depression, the historical, the track record of the gold standard is not great. And something that's an even harder currency like Bitcoin, not currency and assets, that would be even bigger.
Let's say we go to a Bitcoin standard, and then you take out $1 million loan in Bitcoin when Bitcoin's $30,000, and then 2 years later it's at 250,000, which is where many people think it's going. How do you pay off that debt? Right? I mean, it just becomes massively deflationary. That's kind of an extreme example, but that's the way I would explain it. The other thing I would say with this whole, this move to the kind of a reset or a new system or Bretton Woods 3, however you want to describe it, for years and years and years, the idea was the dollar was going to lose value and go through hyperinflation, and then that's how it would lose. Well, then over the last couple of years, the dollar despite all the QE, despite all the helicopter money, it actually made it to a 30-year high last year, right? And then it became, well, the dollar is going to not lose value versus other currencies, but it is going to lose value versus things. Okay, no problem. Again, all fiat currency loses value against things. This is not a uniquely US thing, but the US is losing less against things than the other currencies. And then the argument became, well, okay, so the US dollar is rising versus other currencies, and we're still using dollars globally, but the US dollar is just not the global reserve anymore. It's a global reserve currency, but it's not the global reserve asset. They're going to buy, countries and companies and central banks are going to buy real assets, gold, other, industrial commodities. Okay, well, that's a commodity bull market. If the dollar is still the global reserve currency and still used for the majority of trade, but now rather than just holding US treasuries, they also hold gold and some kind of commodities, that's a commodity bull market. That's because all currencies are losing value. And the other thing I would say is when you look around the world and all these central banks have been buying gold. Okay, and the idea is, well, why are they buying gold? Well, because the US dollar is losing value. Well, okay, but their own currencies are losing value as well. I mean, if you're in Brazil, you probably want to own, and you know how bad the real is, you probably want to own some gold. If you're in China and you're going to have to print a bunch of yuan to deal with your real estate market, you probably want to own some gold, right? And so the idea that the reason that all these central banks are buying gold is only because of the dollar losing value. It's crazy because these other currencies are losing even more value than the dollar is. So if you're in an emerging market country, you better be glad your central bank is buying gold, because again, just because you're buying gold rather than U.S. Treasury, it doesn't mean that the U.S. dollar is losing its currency status. Yeah, maybe they're not putting all of their reserves in U.S. Treasuries anymore, but again, this is a reflection of a commodity bull market than it is a change in the system itself.
Brent, what are the circumstances under which the dollar appreciates against other foreign currencies versus when it depreciates? In particular, I'm thinking of interest rate differentials as well as the differences in growth. If the U.S. is growing a ton, the rest of the world isn't, vice versa, or the rest of the world is interest rates really high and the U.S. has zero interest rates, or in the case of Japanese interest rates are at zero and the Fed hiked rates a ton, and then you had a huge devaluation in the yen last year, which has slightly reversed itself. So how do things play out?
This dollar smile explanation, and if I remembered the person's name, I would quote it, because this is not my analysis, this is theirs, and I think it explains it very well. Is that you have the dollars high on one end, it's low in the middle, and it's high on the other end, right? So there's this smile, and the smile is basically when things are really good and the economy's growing and the Fed is raising rates. Well, then people want to invest in America because you get paid a higher rate for holding onto the dollar, and things are expanding. The reason they're raising rates is the economy is expanding. You want to get in, you want to buy U.S. assets, watch them appreciate. So under that scenario, the dollar does very well. On the other end, things get really bad. Some kind of a global crisis, global liquidity dries up. And because there's all this dollar debt in the world, and you need dollar debt to not only do business with the United States, but service your EuroDollar liabilities, the dollar becomes in great demand on that side of the smile as well. Now, in the middle, if things are just okay here, we don't have a crisis, we're not really growing, we're kind of stagnant, but things are better somewhere else, then that's when the dollar would typically fall versus other currencies. And I think we're kind of in this place now where we're probably going to swing back and forth fairly quickly, be things being good and things being really bad. I don't think we're going to spend a lot of time with the US being stagnant while the rest of the world is doing great. And the reason I say that is because I think we've reached this point in the cycle, this grand cycle where this debt super cycle where debt is going to matter. And I don't think that we have a situation where the US can go into a massive recession as a result of its problems, while the rest of the world can grow and do well despite their problems. So I have in my mind, there's a scenario where the whole world does okay together somehow, whether it's due to money printing or whether it's due to bailouts or whether it's some new technologies discovered, the whole world could grow together and be okay. We could have a situation where the whole world could go down together because things get really bad. In that scenario, everybody goes down together. I could see a scenario where the U.S. does okay while the rest of the world does very poorly. But I cannot see a scenario where the rest of the world does well and the US does poorly. Now, is it possible? Yes, it's possible. But to me, that's a very low probability event. And so in 3 of the 4 scenarios, I prefer to be in US dollar and US assets. And if the 4th scenario does come, I think in that scenario, I'll be okay as well. But I would have to pivot under that scenario. But I think that scenario is pretty unlikely, and I've never really seen that play out yet. And again, the reason it's very hard for that to play out, it's very hard for there to be a lack of dollar liquidity inside the United States, but plenty of dollar liquidity outside the United States, just based on the design of the system. So the idea that credit's going to be contracting in the United States in dollar terms, but it's going to be expanding in dollar terms outside the United States, to get your head around that and figure out how that would actually work, I think is a big challenge. And that's why I think it's a real low probability event.
That makes a lot of sense on a long-term basis, but it is true that China right now is emerging from a recession and the US probably is entering a recession. So you do have that kind of, other countries could be doing well economically when we might not be well in the short term, like next year.
Yes, I agree, and that's where you could see kind of the bottom of the smile. I don't think we could stay there for very long, but we could absolutely stay there. And this goes back to something else I should say is I've always said that I think this will take a lot longer to play out than most people. These things always take longer to play out than you think that they should. And I'm not sitting here saying that the dollar had a big run last year, it went to 115, it's pulled back to 102, so it's still at its highs from COVID. But it's possible the dollar goes back to 95. Maybe it goes back to 90, and we have this lull for a year or two. Maybe the Fed comes back in and central banks around the world provide liquidity, and we get another cycle of QE where asset prices rise, currencies lose value, and then we hit the wall 2 years from now, 3 years from now, 4 years from now. But the point I would make is that the dollar going down does not solve the problem. The dollar going down takes a little bit of a pressure off the global economy that allows it to expand. But as the dollar comes down, the rest of the world will just issue more dollar debt. They will continue to transact in dollars. If they don't transact in dollars and they start de-dollarizing, then there's going to be less dollars circulating in the world. And if there's less dollars circulating in the world, it's going to be harder to service those US dollar liabilities outside the United States. And that typically would lead to a contraction, not a boom. And so, like I said, maybe it's possible that the world provides, gets together and provides another QE round and we kick this can down the road 2 or 3 years. But this is not going to get resolved with the dollar going lower. In my mind, the way that this all gets resolved and the way we have this big reset is the dollar going higher.
Right. And that final leg of the stool are those dollar-denominated debts. And as you say, the U.S. issues a ton of debt, both corporates, but the government as well, but also foreign governments and foreign companies, they have dollar-denominated debts as well. So there's countervailing pressure. What do you think about the fact that the U.S. does have a ton of debt and that we are coming up on a debt ceiling whereby if politicians don't get their act together, the full faith and credit of the United States could be at question. And the following argument that in order for the U.S. to remain current on its debt, the Federal Reserve has to keep interest rates low via some form of yield curve control, which might be a threat to the value of the dollar against other currencies.
I think to a certain extent there was a big confusion on why the dollar got strong last year and then why it's fallen off over the last 6 months. And to my mind, there's really very little confusion. It's all the movement of the dollar over the last year is almost all, not all, but almost all related to interest rate expectations. It was about a year ago that the rate hike started and the rate hike expectations kept increasing. And as the rate hikes happened and further rate hike expectations kept rising, the dollar rose along with it. Towards the end of last year, when Powell made the comment, we still have more room to go, but we have accomplished a lot. We will be data dependent. And at some point, we would expect that we will be done. He said something along those lines, right? Well, so when data started coming in a little softer, when inflation expectations started to peak, and then interest rate hikes, the future interest rate expectations fell, and even future cuts started to show up in expectations, the dollar has come back off. And so, the last year has really traded on interest rate expectations. Now, I think what's happened also over the last 6 months, it's interesting that it happened at the same time. And it also, I think, explains why the dollar has fallen so much in such a short period of time. Again, we talk about it falling so much. It's fallen 12, 13%, but it's still higher than it was at the COVID crisis, right? So, the whole zoom out thing, I think, is appropriate. But what else started happening about 6 months ago, about the same time that the rate hike expectations started coming down, is we started to bump up against the debt ceiling. Okay, this is important. This is a little bit hard to explain, especially if people are not familiar with this. But let me explain why it's important. Around the same time, you started seeing these, where Powell said we're going to continue to raise, maybe not at the same pace, but we're going to continue to QT. At the same time, you started to see these articles and these headlines that would come up that Yellen's efforts or Yellen's actions are counteracting Powell's efforts. And what the Treasury is doing is actually flooding the system with liquidity, which is counteracting the QT that the Fed is doing. So you've got the Fed and the Treasury acting against each other. The reason this started to happen was because we started to bump up against the debt ceiling. So as the U.S. Treasury, they are authorized to issue bonds, take on debt based on the authority from the government, from the Congress. And they have they've put this debt ceiling in place. The debt ceiling always gets raised because Congress always wants to spend money. But whenever we hit it, it always becomes this big theater. They act like they're not going to raise it, and they hem and they haw, and they go on TV. And then, of course, they ultimately raise it. But in that period of time where you're up against the debt ceiling, the Treasury cannot issue new bonds because they can't go over this limit. So as old bonds mature and the debt falls, they can issue new bonds to replace those to keep it at the limit, but they can't issue incrementally net new debt to go over the limit. Okay? So what that means is that the pace at which the Treasury has been issuing bonds over the last 6 months has fallen dramatically because we're up against the limit. And the cash that the Treasury has in their bank account at the New York Fed, they still spend that. So typically what happens is the Fed or the Treasury spends money into the market, and at the same time, so they're giving liquidity to the market. At the same time, they're issuing bonds, so they're putting bonds into the market, and they're taking liquidity out of the market, right? Mm-hmm. So typically, there's kind of a net zero. They're spending money, but they're taking money in. They're spending money, but they're taking money in.
And they're not allowed to have a negative balance by law. They're in a country, you can print as much. A king, I'm going to clip my coins, the gold devalue. Yeah. But under U.S. law, again, this is just a framework. The Treasury can't have a negative balance at the Fed, right?
Correct. And so so they had a very high balance from all the bonds that they issued, during COVID and when the debt ceiling, $2 trillion. They had, I think they had up to 1.5 or 1.6 at one point. I don't remember I can go look it up. But the point is they've been drawing that down. They've been spending it, and now they haven't been taking any in because of the debt ceiling. So now over the last 6 months, they've been spending money into the market, but they haven't been draining it. And so that has given a relative amount of liquidity to the market that otherwise wouldn't be there. Now, what happens when the debt ceiling is raised? Which, listen, number one, it absolutely will be raised. It's just a matter of when. When that debt ceiling is raised, the Fed is going to be in there selling bonds like crazy, and they're going to be draining a lot of that liquidity. And if you look historically, whenever we have bumped up against the debt ceiling, it has historically been a weak time period for the dollar. And as soon as that debt ceiling has been raised, the dollar typically tends to appreciate. Now, there's always exceptions. It's not always the case, but I'm just telling you historically that is what has happened. So I would expect that to happen again this time. Now, let's go back to what happens if they don't raise the debt ceiling and we, quote unquote, default. It's possible that we could have a very temporary default, and then, because then the Congress would really get together, they'd pass it, and, we'd pay the coupon, 10 days late, 30 days late. That would obviously not be a great thing. But here's what's interesting. If you go back to 2011, when the U.S. debt was actually downgraded. Now think about what this means. This means that there's fear that the Treasury bonds won't be paid off. The last time, so when the debt was actually downgraded by the S&P, by Standard & Poor's in 2011, you would think that would send Treasury prices down because they're not being paid. Well, no, actually, Treasury prices rallied like crazy. And it's because it was going to cause chaos in the financial markets. And everybody knows that the US government will at some point pay those bonds and pay that interest. Now, they may pay for it with printed money, but they are not going to default. Then they may default in real terms, right? Because of the inflation involved. But they're not, there's no real danger that you're not going to get paid your dollars that you spent for those treasury bonds. And people knew this. And so they bought treasury bonds because they knew they would rally, right? And that's exactly what happens. Could something like that happen again? Yeah, sure, it could happen. And with all the political, clown show that's going on these days, it wouldn't surprise me at all. But the debt ceiling will get raised, and the U.S. will start issuing bonds again. And here's the other thing I would say: everybody, not everybody, the common refrain now is that the U.S. is going to have to go back to yield curve control. There's no way that they can pay off these debts without printed money. The banking system is in trouble. They're going to have to bail out the banks, so they're going to have to print dollars. The real estate market, the commercial real estate market is a disaster. They're going to have to print money to take care of that. Okay, let's take all of those. A year ago or 6 months ago, you know what was happening in Britain? They had to go in, and they had the Bank of England had to bail out the UK sovereign bond market. At the same time, the ECB set up a facility to buy periphery bonds because Italian yields were spiking. And at the same time, China was having to dramatically decrease or dramatically ease money, do easy monetary policy to deal with their real estate market that was crashing. At the same time that the Bank of Japan was having to intervene in both the yen market and the JGB market for all of the reasons that people are worried will one day happening to the United States. So my point is that yes, these things can absolutely happen in the United States. They probably will at some point happen to the United States, but they are already happening and happened a year ago or 6 months ago in many parts of the rest of the world. So this idea that this is a uniquely US problem, we're the only ones that are going to have to print money. And as a result, the US dollar is going to get inflated away and whatever it is, hyperinflation. It just is historically wrong. And think about everything they did after COVID. Let's just go all the way back to the global financial crisis. QE1, QE2, Operation Twist, QE3, helicopter money, bailouts, PPP, scandal at the Fed, the Donald Trump saying they need to cut rates. All of these things that have happened to the dollar over the last 15 years should have sent it much lower. And yet 6 months ago, it was at a 30-year high. So, again, it's important to understand that fiat currency loses value over the time. It's important to understand that empires always fall at some point. But it's also important to understand that, inevitable is not the same thing as imminent. And going in on a low probability event is not the same thing as going in on a high probability event. And it's just important to keep all these things in perspective, zoom out, so to speak, as you're taking a look at these events and trying to allocate your portfolio.
Thanks for that, Brent. My final question for you is, I know the Chinese Belt and Road Initiative makes a lot of loans, to other countries, some of which other countries are struggling to pay back. Are those loans typically denominated in dollars or in yuan? And what do you think of the odds of a yuan milkshake?
Well, the Belt and Road, you're right, though. A lot of those bonds are coming, or those loans are coming under pressure. If you think about the Belt and Road, it's really a copycat of what the U.S. did with debt diplomacy around the world for much of the last 50 or 60 years. In many cases, China doesn't necessarily mind if they default, because then they get to go in and extract natural resources or take over an airport or a railway or whatever it is. So in many ways, that's kind of part of the strategy. A lot of these Belt and Road initiatives have been done in dollars. The China has used their dollar surpluses to extend credit in dollars. I think as this dollar shortage, I think that will happen, comes up in the years ahead. I think these will increasingly come under pressure. The problem with trying a Chinese yuan milkshake is nobody wants yuan. It doesn't even trade outside of China very much. There's an internal yuan and an external yuan, but the external yuan is really just to get another foreign currency and go on your way. Like nobody's holding yuan balances in their accounts, and so if there's no demand outside of China for yuan, it's really hard to see a yuan milkshake. Again, the whole reason that I coined this term, the dollar milkshake, is there's so much demand for dollars outside the United States. That's really the key to it. This euro dollar market that exists outside the United States and creates an incredible amount of domestic currency demand outside the United States is really what sets the dollar apart. When the US does QE or prints money or however you want to describe it, they're doing it for the whole world, right? When Japan does it, they're doing it just for Japan. When Europe does it, they're doing it for Europe. When China does it, they're doing it for China. So because there's so much demand for US dollars, this allows the US to kind of quote unquote get away with it to a greater extent than the rest of the world without their currency, going through, hyperinflation or just disappearing.
Right. Oh, Brent, I'm just going to find a question about last time we spoke, which was at a Blockworks event in New York, which, by the way, as soon as you were about to tell me really interesting argument about between the Fed and the Treasury, the emergency fire alarm went off. So it's kind of like, the Fed, the Treasury, they don't want you talking about this. But at the time, you were worried about a sovereign debt crisis. How have your worries about that evolved over the past 6 months? And to what degree does the Federal Reserve drastic rate hikes play a role in that?
Well, number one, my fears have not subsided. Interestingly, it was about a week after that, conference or that interview where we were talking, where the Bank of England had to bail out the gilt market. Right, that's when the Bank of Japan had to step in and support the JGB market. I mean, that is a sovereign crisis. When central banks are stepping in to save their own sovereign bonds, that is at least the early stages of a crisis. Central banks are extremely good at kicking the can down the road, and when volatility strikes, that's their job to come in and calm the markets. And they did. I give them credit. They came in. Most of those markets were in crisis, and they came in and they calmed things down. And 6 months later, those currencies have rebounded, and those economies have come back from the brink. But I have no doubt in my mind that we will revisit those same issues. And a big reason is because of the interest rate hikes by the United States. The reason that China was in a tough spot last year, the reason that Japan was in a tough spot, the reason that Europe was in a tough spot, the reason that many countries around the world were in crisis last year was because the US dollar was getting stronger. And the reason the US dollar was getting stronger was the rate hikes. Now, as the rate hikes expectations have backed off, that has allowed the dollar to come back, and that's taken the pressure off of the global economy. But if you think about it, if you think that debt matters, and if you think we're going to have some kind of a reset due to asset prices coming down, then that means that the dollar is going higher. You're not going to have asset prices crashing along with the US dollar crashing. It just doesn't work that way. The reason that asset prices crash is the availability of dollars dries up and the price of the dollar goes high. Now, the reaction to prices going down, meaning central banks come back in and provide liquidity, the reaction to the crisis could make the dollar go down, but the crisis itself involves the dollar going higher. And so that's why I say, if you think that more QE is coming, then you're actually a dollar bull, right?
Right. Because before the QE happened, there will be a crisis, and during that crisis, asset prices will fall, commodity prices will fall, assets and commodities are priced in dollars, and the dollar will go up. And that's why, right. So the Federal Reserve printing a bunch of money. Some people don't like the word print, but we're just we're going to go with it.
It's the easiest way to explain it.
Yeah. Increases the supply of dollars and it could push it up, but there's going to be a crisis in the same way that during quantitative easing, interest rates actually rise, but that's because it just coming into crisis. And when there's a crisis, interest rates are very low. The dollar value is very high. Brent, we'll leave it there. Thank you so much for sharing your insights. Folks can find you at Santiago AU Fund on Twitter. What's your website if people want to learn more?
A friend of mine and I started a show we do a couple times a week. It's really kind of a lighthearted show that covers kind of finance, politics, markets. We call it Milkshakes, Market, and Madness because there's plenty of madness out there. But if you go to milkshakespod.com, you find the website, and you can find it on YouTube and really all the different podcast platforms. And I think you and I have done a few interviews in the past. Probably find them on your website as well. And I would encourage people to find them either on your site or on YouTube or wherever. I appreciate you having me on. I think it's kind of an important time to talk about this stuff. Again, I'll just sign off and say, I don't know what's going to happen, but what I know is that all the headlines don't tell the whole story. So, you got to do your homework. You got to pay attention. You can't just accept what a headline says and think that that's going to be exactly the way things play out.
Definitely, Brent. I just have one more final question, which is for you. The theory first proposed maybe by Charles Kindleberger, I don't know, but there needs to be a currency hegemon, however you pronounce that word, the sterling standard, the pound sterling, the Dutch guilder, the US dollar. There has to be something. It can't just be China's doing business in yuan, India's in rupees, the US in dollars, and we're all sort of on the same level. No, there has to be a hierarchy, the top of the pyramid, someone to save the system, someone to bail everyone out. Do you believe in that? And that, you say you believe the dollar standard will be here for a very long time, but if and when it is replaced, will it be by there is a number one currency, or could it be something like a multilateral system that's more equal?
I think we could have a multilateral system for a little while, but I don't think it would last for a very long time. And part of the reason is, and this gets a little philosophical, but in many ways, global reserve currencies are not about economics. They're really about power. And it's about an imposition of will. And whoever the biggest, baddest boy or girl on the block is typically enforces their will. Now, you might not have to like that, but that's typically what history plays out as. And if you're going to do business with the biggest, baddest girl or boy on the block, you're probably going to have to use their currency or whatever they would like you to use. And so I think that's why you can have these relative short periods of multipolarity or multi-currency or regional blocks. But ultimately, I think the conflict that comes out of that, we'll see a hegemon emerge. And when that hegemon emerge, they typically don't care what anybody else thinks. and I think you will be subject to whatever system they would like to put in place. And the thing is whatever system they put in place, it doesn't have to make sense. Think about the Soviet ruble. It lasted for 60, 70 years. It didn't make a lot of sense. It didn't have a lot of economic power behind it, but it lasted for 70 years because the Soviet Union imposed their will on the people underneath it. And so that, just because something doesn't make sense doesn't mean it can't work for at least a while.
Right. Brent, thanks again for sharing your insights, and thank you everyone for watching.
Thanks for having me.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.